So we begin with our top story. There's two widely held assumptions right now that economies stabilise and the rally has further to go.
Our base case is that the U.S. stabilizes.
Stabilization, if not improvement, in the second half of the year.
Initial signs of stabilization in the Eurozone.
We see China stabilizing.
I think China's forming a bumpy bottom.
Stabilization that's coming through in the economy from those stimulus measures.
The story is mainly about China.
If China does stabilize here
and even improve a little bit,
as we think it continues to do so,
that'll help Europe, that'll certainly help the U.S.
Markets still have room to move up on the back of that.
Plenty of room to run.
We've probably seen two-thirds of the rally we're going to see this year.
There's more upside there.
A little bit more juice that can be squeezed out.
Joining me around the table here in New York to continue the conversation, Priya Misra, TD Securities Head of Global Rates Research, Brian Nick, Nuveen Chief Investment Strategist, and Mohamed El-Erian, Allianz Chief Economic Advisor and Bloomberg Opinion columnist. So, Mohamed, let's begin with you. Those two widely held assumptions, one being that where China goes, everyone else follows, the global economy stabilises, and the outcome of that being the market has further to go. Do you challenge the first assumption?
I do. I think China is necessary but not sufficient. You also need to see a pickup in Europe, and we're nowhere near that point. Yesterday's German numbers were disappointing yet again. So there's a question mark about the global economy. I think divergence is a much better theme than stabilization and pickup.
What do you think, Priya?
I do agree with the divergence point. I think the U.S. rate market, though, is not pricing in your first assumption. I think U.S. rates went from pricing in this Fed policy mistake late last year to patience to panic. You know, why was the Fed so dovish? What does the Fed know that we don't know? So I think now we're actually the rate market, which is pricing in an entire rate cut this year, an entire rate cut next year. I think the rate market is telling you, well, we're kind of nervous about not just the global economy, not just China, but we're worried about is U.S. growth also rolling over.
That's where this tension is, this tension between risk assets and between what rates are ultimately pricing in. A lot of people trying to work out how that reconciles. That can remain this way for quite a while, can't it?
Sure, and the fact that rates are low could potentially be helping the U.S. economy. We're seeing, new activity in the home sector in the U.S. economy, better housing starts, perhaps than we would have expected otherwise. And a lot of the data that we're getting, even though it's been disappointing for February, it's coming with positive revisions in the month of January. So it's potential.
That's a good point.
We weren't actually coming into the year quite as weak as we thought. And this, reaction in the rate market, especially on the very short end, that there's going to be these imminent Fed rate cuts. If we get a 1.5% GDP growth number in the first quarter, that's not going to sound the alarms with the Fed.
But Brian, you're mentioning the US data. Abroad, Mohamed, it was really interesting to me yesterday, and you've brought this up, so let's explore it, how willing market participants were to look through a German PMI that far below 50 just because the Chinese PMI was so much better. Is that a mistake?
I think it is a mistake. I think, first, it's understandable because China is the second largest economy in the world, so it is understandable that people look there first. And the beat was considerable. So, I understand why that led it. And then you got the US number. So the German number, which was a revision, it wasn't a new number, it was a revision, was ignored. Having said that, you can't get a synchronized pickup without Europe. On the rates, I think there is a discussion out there, which is it really about US growth? Or is it about global growth and inflation? Is the market expressing a view that growth in the US may be fine, but inflation is an issue, which means that the Fed may target an overheating rather than staying where it is? And also, let's not forget the spillovers from the rest of the world.